So when the market goes sideways, as it did in 2022 so far, a lot of investors starts to get nervous and they're about to panic. And at one point, they just want to sell and get away from the market. But we all know it's not the right thing to do. How can you invest with more conviction? Well, one thing that helps a lot of investors is to understand fully in what they invested. And if there's one industry that is easy to understand and that you can actually see what's happening from your own eyes as just a person walking into a store, going into an office, or renting an apartment in an apartment building, is REITs. So today we're going to talk about how you can select REITs, why they are a good choice for your portfolio, a few things about lingos, and at the end of this video I'm going to share with you all my favorite REITs from Dividend Stocks Rock. Dividend growth investors, bonjour, my name is Mike Hiroux and I'm the founder of Dividend Stocks Rocks. I'm also a passionate investor which has this YouTube channel to help you invest with more conviction so you can enjoy your retirement. So why I want to talk about REITs today? Well, the first thing is, quite honestly, it's very hard to find a place to park your money and make some these days, right? Actually, when you see this graph, there's only one sector that has been doing very, very well since the beginning of the year, and it's the energy sector. All the others are down, and REITs are among the most affected by the rise of interest rates. Investors are nervous. They're not too sure how they will be able to continue this leverage strategy to grow by borrowing more if interest rate goes up, right? So we're going to take a look at REITs a little bit more and why they are a good place to your portfolio. Since the entire sector is down, this is probably one of the best time to take a look at them and to add some in your portfolio. And this is actually what I did. Again, that's not financial advice. Do your own due diligence. But what I did with my money recently is I added some REITs to my portfolio. So you might want to check them out. Not saying it's a good thing, but you never know, right? So why REITs are so interesting right now? Well, first, recurring source of revenue. You know, all the tenants, they pay monthly, so it's easy to predict cash flow, easy to manage the business. It's also easy for investors to understand what's happening. You know, when I go through a shopping mall, I know that probably REIT owns it or another big company owns it. And then I can have like this view and perspective of what's happening, seeing people coming in, going out. I know that it is very concrete in my mind. They also very generous in terms of yield. Most of them will distribute a large part of their income because it's part of their tax structure. Therefore, a lot of REITs will offer you a 3, 4, even 5% yield, which will be safe. And some of them goes even one step further and they increase their distribution every single year. Also, it is a total protection against inflation. Why? Because it's super easy for landlords to pass the inflation and all the other costs that are rising to their tenants. A lot of companies has long-term contract, but they include an escalator rate in it. This means that every single year, the tenants already know in advance that the amount that they pay monthly will increase according to either inflation or any type of increase. Finally, they are usually strong against market crash. It is usually a good protection because when you're investing in tangible assets, everybody loves that. It gives you more conviction, so it's easier to understand and you feel a little bit better. As I mentioned earlier on that graph, they are on sale and this is why you should take a look at them. Make no mistakes though, just a quick parenthesis on that, REITs are not safer than stocks. It's not because you invest in properties that it will not fluctuate. What you see on this graph is two examples. First one is Essex Properties. As you can see, it almost doubled in value, but with a lot of fluctuation. And the other one is REIT, which seems to be quite stable. Unfortunately, after the pandemic, it was a big hit. Now it went back up and then it's going back down. But the point here is not to compare Essex to REIT. Actually, they have nothing in common. One is an apartment REIT and the other one is a shopping mall trying to make the move towards more residential and condos. But in the end, what I want to show you here on this graph is even if you invest in REITs, you are going to see fluctuation in your portfolio. You may suffer from dividend cuts, which are distribution for REITs, but you may lose income, you may lose capital, so you have to be careful and you have to approach REITs the same way you approach stocks. The first thing that you should do is to understand where is your money going. You have several sub-industries, and the sector of REITs is one of the very interesting one because you could probably have like 30% of your portfolio invested in REITs and still be widely diversified. As you can tell, retail and offices will not operate the same way as industrial REITs or residential REITs. Mortgage REITs is a completely different beast, and actually I did a complete webinar about how to pick up your REITs, which is like more than 1 hour long. I've put the free replay in the link description below, so if you want to have more information on mortgage REIT, how they work and how each sectors and sub-industries work and will provide you, you can go and watch the entire webinar. This will give you a lot more information than this small video. As you can see, we have companies that will offer you pretty much like a good balance between a decent yield and some growth. So you will find them with industrial. Now occupation rate is close to 99% for pretty much all industrial REITs, which is amazing. You have diversified, so those companies touches a little bit like everywhere. So you'll find a lot of REITs that, yes, they have like maybe 20% in industrial, but they also have like 30% retail and then another some percentage in offices. Residential REITs, which have apartments, they will fluctuate a little bit more. Why? Because most of the time their contract are just for, their lease terms are just for 1 year, and then they could change tenants. So it brings a little bit more volatility, but it's easier for the REIT to adapt to the market. And if the market is good, they can rapidly raise their rent faster than retail or offices REITs, which has long-term contract. In the growth categories, you'll find specialty REITs. Easiest one to think is data centers. Obviously, they're well known. They have went through a big surge over the past 10 years. Now you're probably a little bit late in the game, but those REITs, they do not pay a high yield. You have to find something else if you're looking for income, but they will provide you more growth perspective. At the very bottom, I put hotel, motels, and healthcare with a little star. Why? Because right now, they're having a hard time. They have suffered so much from the pandemic. It will be harder for them to get back in business and become dividend growers again. So you can look into them, but they will be more speculative plays. Once you have determined the subsectors that you want to invest in, the second step is to know your REIT. Know what you invest in. We're talking about the business model, but we're also talking about the structure. So are we talking about a REIT with long-term leases or short terms? What is the occupation rate? So you'll see healthcare will have like occupation rate between 80 to 90%. Industrial, as I mentioned earlier, up to 99%. So the demand is super important because you need to know if the REIT will have empty offices or empty properties. This will hurt cash flow a lot. Rent collection has been a major topic over the past 2 years because when you start to have deferred rent, it sends you a strong signal that some tenants are not doing that well, and then you might get up into some trouble. In terms of diversification, we're looking at geographic diversification. So we've seen REITs focusing on just a specific state or province, like Essex has most of its properties in California, and the others that are not in California, they're in Seattle. So they are targeting tech hubs, and that's it. They're nowhere else. So if California is doing well, the REIT has good chances to do well. If the state of California is having big troubles and the economy goes down, they will suffer. The other thing that you want to look at is the tenants. So you want to see at least their top 10 well diversified, not a big part into just one big tenants, because then the entire business is dependent on that businesses, and then you may run into some other troubles. It's super important to understand the lingos that is different from corporation to REITs. So REITs have a different tax structure. They have to distribute most of their income. And for that reason, we cannot use earnings per share. We don't talk about dividend, it's rather distribution. So it has a big impact on the tax implication on that. I'm not an accountant, so go check that out. We're not talking about payout ratios, we're not talking about earnings, but rather about funds from operations, so the money that their properties generates, the funds from operation per share, FFO per share, and the payout ratio is also based on the FFO. So it is really important to make the difference between type of metrics that you usually look at when you look at a stock. They're not the same for the REITs. I've actually been able to adapt the dividend triangle that we have at Dividend Stocks Rock. So we usually look at three metrics: revenue, earnings, and dividend growth. In this case, we get the revenue because it's pretty much similar, so that's all right. And then you have the FFO per share. Why are we talking about the FFO per share? Well, it's quite easy. A lot of REITs will not only leverage the equity in their properties to buy more properties or to finance development, but they will also issue a lot more units or share. When you issue more units, the problem is you dilute the value, and then the FFO per share or per unit will be lower. So the ability to increase the dividend will be smaller at the same time. So it's important to say, okay, so the REIT is auto-financing themselves by issuing more units. People are buying them, so it dilutes the value. It increases the dividend payment that the company has to write. So the check is bigger, but you only receive the same thing. And then if they're not able to create additional value, the FFO per share will not move. So you see here, Granite REIT has a strong trend of revenue, strong trend of FFO per share, and you don't see it because they paid a special dividend, but they have also increased their dividend over the past 5 years and even more. So this is the type of business that I love. And when I see this one, full disclaimer, I bought Granite REIT a few months ago. When I saw that it was going on the downtrend, I thought, here's my occasion. I'm going to fill it up, and I'm going to add this great dividend grower, industrial REIT. So balance between stability and growth is just great. Now, if you want to be on the safe side, you need to make sure that your dividend is safe. The first thing to do, look at the dividend triangle. That's super important. The second thing to do is I would look at dividend growth, distribution growth over the past 5 years. If a REIT with a strong economy and low interest rate is not able to increase its distribution over the past 5 years, you have a clear signal that there's something wrong. Then you can look at the FFO and AFFO payout ratios. If they're close to 100% and there's no dividend increases, well, now you have your signal that you may not have a champion in your portfolio, and you have to treat them very carefully. It's not because they're super generous with yield that you should keep them, because a catastrophe could happen. Here's an example. H&R REIT was a sell back in 2018 and 2019 at Dividend Stock Rock. Why? Well, you can see on this graph. Revenue decline, FFO per share decline, and no dividend increases. What happened? Well, everything was well until we got the pandemic. So we hit a speed bump on the road, and then boom, everything goes sideways. The revenue continued to decline, the FFO per share continued to decline, and bam, your share value your share value is down and your income is lost. If you want to focus a little bit more on what really happened during the pandemic, you can clearly see it. You see that there was no income generation, no income growth at one point in your portfolio, and then boom, you lost a big part of it. And on top of losing income, you lost your capital. So as a retiree, it's really hard to go back to work and then rebuild that portfolio that you worked so hard in the first place. You don't need those kind of REITs in your portfolio. You need REITs that will be solid, that will show some growth, and that will have healthy payout ratios. How you can find those? Well, actually, if you're using free financial stock screener, it will be sometimes very hard to have specific metrics for REITs. They will provide you with the classic payout ratio or the the price earnings ratio, which are not going to give you much information about the ability to pay a dividend or the valuation of the stock. So at Dividend Stocks Rock, we decided to create an entire stock screener for REITs. We track net operating income, we track FFO payout ratio, AFFO for adjusted payout ratio. We look at the net asset value. So we have all of those specific metrics for REITs to help you screen through 140 something REITs, both on Canada and the US. You have the link in the description below if you want to see what it looks like. Actually, in the webinar, I make a full presentation on how to use the stock screener. So you want to have a look at this. And this is how you're going to be able to find the right REIT for your portfolio. As promised, I wanted to end this video with a kind of like a small freebie. So what I wanted to do here is to list some subsectors and then my favorite REITs for the US part and the Canadian part. Again, in the webinar that I've done a couple of months ago, I discuss all of those stocks. You'll have more information on them, and then it's a good start if you want to start your research and add some REITs in your portfolio. Most of them, they show great dividend triangle, they show dividend growth for the past 5 years, and they have healthy balance sheets. So those are like super important element. I hope that you have enjoyed this video. If you had any questions about REITs, go in the comments below, send them out. Let me know about your favorite REITs actually. Do you have like any high yield REITs that are not part of this presentation, or that are not part of my favorite REIT that maybe we can discover together? That will be fun. So head on to the comments below. Give me a thumbs up. Don't forget to subscribe to the channel. Every Thursday morning, I publish another video. While you're watching those, actually, I'm currently in Africa, which is kind of cool, but I'm gonna still look at my comments here and there. But don't forget that, don't worry, all summer long, I will continue to post my weekly videos. And until the next Thursday, don't forget to stay invested.